Hello, and thank you for joining today's presentation on buying real estate. And tonight we're specifically going to discuss numerous free money down payment assistance programs to help first-time buyers and also repeat buyers. If you have any questions, please type those into the chat and we'll answer all and any questions at the end of tonight's presentation. And with that, let's get into it. Discussion points for this evening. We're going to do a quick intro on who we are, who's a Capital Realty Group, and who I am. Then we'll talk about renting versus owning, the advantages and disadvantages of each. We'll talk a little bit about free money and down payment assistance programs. We're going to cover a little bit about different programs so that we can cover numerous programs tonight. We're going to discuss California state-specific programs, San Diego County programs. We'll also discuss some city programs in cities like San Diego and Chula Vista. We'll also talk about some federal programs. And all of these numerous programs can give you access to money to help you buy your first home. We'll close it out then by discussing steps towards buying your first home, which will be very important to know, especially if you're a first-time home buyer. And then we'll move it into Q&A. Quick background on myself. My name is Patrick Capel. I'm the team leader of the Capital Realty Group. I have a little over 15 years of real estate experience in the San Diego real estate market. I'm a board member of the Southern California Rental Housing Association. Our team, the Capital Realty Group, has sold just over $500 million in just the last 5 years. So we are very well versed in San Diego real estate with that many transactions and sales. I also serve in the Navy. I've been in the Navy for over 20 years now, 24 years to be exact. I served 11 years on active duty, and I continue to serve in the Navy as a Navy reservist. You can see the education there in the center, and it's that education that I approach these webinars from. You see I've got a Master's of Science in Real Estate from the University of San Diego, an MBA from UCLA with a focus in finance, and undergrad from the U.S. Naval Academy. And I learned that really education is the key to all success. And certainly as a first-time home buyer, it's important to get as much education as possible as you approach really the big life-changing event of buying your first home. And before we dive into the topic, I'll end the introduction with one last thing, and that's the introduction to the stellar team that we have, the Capital Realty Group, which you see in front of you. And on the right, you see it says who you work with matters. And more now than ever, it matters who you work with when buying real estates. As you notice in the bullet points, like all professionals, not all real estate agents have the same level of knowledge, expertise, or skill sets. And certainly, most real estate agents are not well versed in what we're going to talk about tonight, down payment assistance programs. You also see there that working with the right agent can save you not just money and time, but it can also help you get the property that you want. In working with the wrong agent, I've seen time and time again, people lose money, people lose time, people lose properties by working with the wrong agent. It's the largest financial transaction in your life, and you certainly owe it to yourself to work with a team of professional, full-time agents rather than someone who's doing it part-time or perhaps is not an expert in an area that you want to take advantage of in real estate, like down payment assistance. So with that, let's get into the knowledge, the education, and everything we're here to cover tonight. Down payment assistance, lending programs to get you free money, because at the end of the day, the key to home ownership is knowledge, is that empowers you. What are the differences between buying real estate and renting real estate? Now, we often think up front that the difference is a cost, and we often see that in the short run, it's cheaper to rent than it is to buy a lot of times. We're going to dispel that myth in about 3 to 4 minutes. But before we get into the myth of it's cheaper to rent than buy, let's talk about some of the intangibles. When you buy real estate, you get to keep your money. You're not paying a landlord, you're paying yourself because you're building equity in real property, the home that you live in. And that equity is going to build throughout time. And over 5, 10, 15, 20 years, you're going to have hundreds of thousands, if not millions of dollars of equity that you build up in your San Diego home. As you build that equity, you're gaining advantage of asset accumulation. So what is that? Like most things in life that go down in value, you can think of cars and other luxury goods. Real estate goes up in value. And as real estate appreciates throughout your life and you're paying down your mortgage, you're gaining asset accumulation. You're gaining personal net worth. So one day you can retire. I can't imagine anyone ever being able to retire, certainly not in San Diego, if they're a renter for life. Buying also gives you financial credibility, and you're going to see that all of a sudden your credit score goes up and your interest rates go down on things like credit cards and car loans, because with financial credibility, paying a mortgage every month, you're going to get better lending standards. You're going to see your credit score go up. You also gain ownership, not just in a house, but in your community. There's a sense of pride and a sense of belonging to community when you own a home in the area you live rather than just rent. And of course, all these things, they add up to financial freedom. If you ever have any hope of financial freedom or being able to retire one day, you certainly are going to be in better odds if you own, because unlike renting, ownership ensures your payment stays the same and eventually goes away. Because with a mortgage, you have a steady payment for 30 years. And after 30 years, your home is paid off, your mortgage is paid off, you're living almost for free. Whereas rent, as you can see on the right, goes up annually. Rent increases. Even if you have a nice landlord that hasn't raised your rent in a year or two, just wait, they eventually will. That makes rent a liability, and not just a liability, but a liability that goes up every single year as your rent increases. And of course, you have no ownership. You lack the pride of belonging to a community by setting down roots, because you don't own anything in your community. You're investing in your landlord who owns in your community. It's hurting your potential to retire while helping your landlord's potential to retire. And even with all the rent control restrictions we have in California, you can still be kicked out of your rental property at just about any time in California. As we already mentioned, rent goes up, it increases annually. So our goal is to help you and everyone out there trade your rent for a mortgage. Mortgage is what gives you housing security, whereas rent is like tossing your money in the trash can. You are guaranteed to never see that money again. Rent is kind of like having a mortgage, where 100% of your payments are interest and you gain no ownership. Whereas ownership gives you access to building wealth through both appreciation and paying down your mortgage and ensuring that your payment is steady throughout time. So what makes up a mortgage payment? Really two major factors: interest and principal. Interest is that portion of a mortgage payment that goes to the bank for borrowing the money. Just like on a credit card or a car loan, you have your interest portion of the payment. Whereas a principal payment, the portion on the right, is money that you're using to pay down the balance of the loan. It's almost like you're paying yourself. If you have a $500,000 loan when you buy a house, over the next 30 years, you pay that loan down. It's like paying yourself back, and you now own your home free and clear 30 years later. Or maybe you make payments faster and bigger and you own your home even sooner. But principal payments are kind of like a forced savings account, paying yourself back. Mortgage payments, when you look at them over a 30-year span, you can see that the principal portion of the payment becomes greater and greater, while the interest becomes less and less. That's because your overall balance, that dotted line, is becoming smaller and smaller. In this case, it's someone who starts out with a little over a $400,000 loan, and over time, the balance of the loan goes down, interest payments become smaller, principal payments become bigger, and after 30 years, you own that home. So let me ask you a question. What if you could rent a place for $3,000, or you could buy and own the same place, but it would cost you $3,990, almost $4,000? Which would you do? Now, most people would say, well, renting, for $3,000 is a lot cheaper than owning it for $3,990. And most people would say they would prefer to rent, just looking at this information. The problem is this information is limited and it's looking at just today, just this year. It's assuming that you're not going to keep on living for forever, at least for another 10, 20, 30, 40 years. And when we look beyond this information, how much is it to rent today? And we assume you're going to live another 10, 20, 30 years, the question starts to become more clear. I want to show you how owning for $39.90 a month is actually cheaper than renting for $3,000. I'm going to show you that with math. And as you see on the right in quotes, math is a universal language that does not lie. So let's look at some math and let's look at this rent versus own calculation to show you how renting for $3,000 versus a mortgage for $3,990 for the exact same property, this condo located downtown. I want to show you how $3,990 not only is cheaper, but it's going to make you $3 million wealthier as opposed to the person who rents it for just $3,000. I also want to show you how the person paying $39.90 a month, after 30 years of ownership, they're only paying about $2,000 a month. Whereas the person who decides to rent today for $3,000 because they think it's cheaper just looking at the surface level, they end up having to pay over $12,000 a month. So how does this happen? And why do so many people think it's cheaper to rent than it is to own? It's because they just look at the surface and they don't peel back the financial layers of the onion to go deeper. So we did that for you. There's an Excel spreadsheet in front of you showing the differences between the homeowner that you see me circling here and the renter that you see on the right, and how much they pay over the next 30 years. And I'm hoping, and I'm sure you're hoping, that you live for another few decades. Now, instead of going into every little detail of this Excel spreadsheet, let's zoom in to the top left. The top left has the important data that we put into the spreadsheet. And then on the next slide, we're going to look at the outputs. So what's the data we put in? We put in the value of this condo is $500,000. We also are going to assume a few things. You have closing costs of about 1%. You have a down payment of 5%, so $25,000. And in tonight's presentation, we'll show you how you can get that down payment covered for you by the government. We're also going to assume that you borrow the other $475,000 at an interest rate of around 6.5% for a period of 30 years. Now, going down to a few more assumptions on the bottom left, we're going to assume that the property appreciates at 6% year over year. And that's a good, 6% is a good amount to use because that's what San Diego real estate truly has appreciated year over year on average for the last 35 years. We're also going to assume that you could rent this property today for $3,000, which you certainly could. I know this property very well. It's one that I own and I rent it for $3,000. And we're also going to assume that your rents go up every year 5%. Now in California with rent control, rent can go up every single year, anywhere between 5% and 10%. We're going to assume you have a really nice landlord and your rent is only going up 5%. In the top right here, you can see a few other assumptions. Your taxes, if you own the property, are going to be about 1.25% of purchase price. And in California, taxes go up 2% a year. No more, they're capped at 2% a year. We're also going to assume that you have insurance that you must pay, and that your insurance payments go up 3% a year, and you have an HOA payment that also goes up 3% a year. Knowing these inputs, what do our outputs look like? We can see on the far right, as we already mentioned, the renter's paying $3,000 a month. The owner is paying $3,990. And this is why so many people mistakenly believe it's cheaper to rent than it is to own. But the truth is, looking beyond your initial monthly payment, you're about to see how it is exceptionally more expensive to rent than it is to own. Even though when you look at the math on the surface, 3,000 seems cheaper than 3,990. Let's look forward and see what happens over the lifetime of a renter versus the lifetime of this owner. Over the next 30 years, the owner is going to be in green, and they paid 1.597 million to live in this property. The renter over those 30 years to live in this same property paid 2.391, almost 2.4 million. So as you can see, the renter who lived in the same property ends up paying almost $800,000 more, nearly $1 million more to live as a renter versus the owner. And that renter fell into the fallacy of the trap of thinking it was cheaper because on year one, the monthly payment was a lot cheaper. But remember, mortgages, principal and interest payments stay the same for 30 years. If anything, your mortgage payment goes down over time because you're likely going to refinance it into a lower interest rate below 6.5%. The renter, on the other hand, their payments go up little by little, 5% a year over 30 years, and they end up paying substantially more. Additionally, obviously, after 30 years of ownership, the homeowner owns the home. The renter still does not own the home. So the renter has to keep on paying rent, whereas the homeowner no longer has to pay their mortgage. Because after 30 years, the homeowner's mortgage is paid off. And now the only thing they're paying is their monthly HOA and their annual insurance, along with their real estate taxes. Now, assuming the real estate taxes, insurance, and HOA, which you see in the top here, go up each year, they still are only going to be paying about $2,000 a month by year 31, whereas the renter's paying over $12,000 a month, not a year, a month. And that might seem insane. How does $3,000 a month become over $12,000 a month? That's the power of compounding interest. And $3,000 going up every year by just 5% ends up becoming over $12,000 a month in rent by year 31. So mark my word when I say this, any rental property in San Diego today that costs about $3,000 a month to rent, in 30 years, it's going to cost about $12,000 a month to rent that same property. That's why it's so hard, if not impossible, for renters in San Diego to ever be able to retire. And that's why in the real estate industry, we call it renter's prison, because you get stuck in it and you can't get out of it unless you buy real estate. And then the biggest impact beyond the cost of living is a change in net worth. The owner, the person who bought the property 30 years ago, owns that first home, that condo, and they bought it for $500,000. But if it appreciates at just 6% a year, year over year for 30 years, by year 31, it's worth over $3 million. And that homeowner is now a multimillionaire, whereas the renter still doesn't own the property. And it's the same property, but the homeowner doesn't own it. They rented it for 30 years. And this is why I say, and this sounds very trite, but it's true. In San Diego, the easiest way to become a millionaire, if not a multimillionaire, is to just buy real estate. Just buy one $500,000 condo. Own it for 30 years. That's a long time. But in the scheme of things, you'll be glad you did, because in 30 years, you'll have a net worth likely in the multi-millions. This is also why I say it is so financially devastating for people to rent. So why would people rent knowing all this information? It's because most people, most human beings, they don't look at all these other numbers going out 10, 20, 30 years. They just look at today. And they just look at what's my payment today, which you see here on the far right. And then they get lured into what I would call a Venus flytrap. And they get lured into that flytrap of $3,000 is cheaper than $39.90. So they end up spending $3,000, but over a lifetime, they spend exceptionally more. Because not only does a renter spend $800,000 more in rent versus the owner paid towards mortgage, they lose out on $3 million in net worth increase, ensuring that the owner, while they might have paid about $990 more the first, second, third year, at the end of 30 years, they ended up $4 million nearly ahead of the renter when you add the 3 million plus the 800,000. There's just no reason to not own. And a lot of people say, well, there's all these hurdles to ownership, like credit score and a job, and got to find the right house, and my income isn't enough for a mortgage, and all these other things. There's ways we can fix that. There's ways we can get through it. We've even helped people that have filed bankruptcy before. We've helped those people get into home ownership. Now, there's a lot of things a person can invest in. Real estate not only is one of the only investments, in fact, it is the only investment that not only it's an investment, but something you can live in, something that you need anyway. You don't need stocks. You can live without them. You can live without bonds. You can live without investing in mutual funds, but you can't live without shelter. So if it's something you need anyway, you might as well own it instead of rent it. But beyond the fact that you need shelter, it's also one of the best investments. We can see here, if someone had $50,000 and they wanted to invest it into real estate and they put 5% down on $1 million property, and that property appreciated, again, it's 6% a year, that property is going to be worth 5.7 million after 30 years. If they took the same 50,000 and put in the stock market, which is earning 12% a year, earning 12%, 2 times as much as 6% of the appreciation of that house, but still it's just 50,000 working for them, they end up with 1.497, the red line here in the graph on the right. So we can see that real estate isn't just a necessity, it's also a great long-term investment. So knowing these factors and attributes of renting versus owning and how financially it just makes sense, let's talk about the biggest hurdle to buying real estate, and it's often the down payment. Now, let me be very clear. Most people that own real estate, many of them didn't have the down payment. They found it from other means. And if they weren't able to get it from parents, mom and dad, they often got it from the government. When I bought my first house, I used a down payment assistance program. I bought my first property in 2008, 15 years ago plus. And I used a federal down payment assistance property to buy my first property, which was a condo in the county of San Diego. So let me share with you the down payment assistance programs that exist today and how you can get past that first hurdle of having the down payment by getting the government to give you the money to go towards your down payment. First, you don't need to be a first-time home buyer with all the programs. Some of the programs you do, some of the programs you don't. There's over a dozen down payment assistance programs. Each of them have different caveats. Each of them have different rules, different restrictions, but I can almost guarantee you that 90% of Californians, of San Diegans, will qualify for one down payment assistance program or another. For some programs, there's no income limits. You can own multiple properties and be an investor and still qualify for some of the programs. But the two most important factors are, number one, the lender you work with matters, and the realtor you work with matters. Why is that? Because these down payment assistance programs are very niche. They're very specific, and most lenders and most real estate agents do not specialize in the programs. They'll tell you that they know them. They'll tell you that they understand them, but they're just saying that. They don't really specialize in or understand them. Within my team, we secured over $500,000, over $500,000 in down payment assistance program financing just for our clients. That's how much we got towards the down payments. The financing The properties they bought with that down payment was over $10 million, but we were able to get over $500,000 for our clients. So the realtor and the lender you work with certainly matters. Now, I want to share with you, we're going to dive into the Dream for All program, which is the big one this month. We're also going to go into some specific San Diego County and San Diego City programs. But what I want to first share with you is a simple website, which you're looking at right now, the California Association of Realtors. This website is going to show us the many programs available to you and many other buyers out there to down payment assistance. Now, you've probably heard about the Association of Realtors and perhaps a lot of the litigation that's happened in the country. But let me first say that the Association of Realtors has done a lot of great things to help people get into housing, including working with many of these programs and creating some programs that help people with down payment assistance to get into real estate. So on this website that we have at the California Association of Realtors, I can simply type in an address. And you see here, I typed in that same condo that we use for our case study. I can type in the zip code, type in the estimated purchase price, and we can see that there's approximately 26 down payment assistance programs. This is why I said there's probably one or two programs, if not many, that fit your criteria, that fit your income. All we have to do after putting in the address and price point of a property is click on view the programs, and we can start to learn more about the different programs that consumers have access to. The California Housing Finance Authority Agency, also known as CalHFA, they probably manage and operate over half of the down payment programs, CalHFA. And that's simply a California organization that oversees a lot of housing and the housing financing behind California real estate. One of their biggest tasks is to help people get into home ownership. So they launch a lot of programs like the Dream for All Shared Appreciation Loan, which we're going to dive deep into tonight. With this loan, you can get up to $100,000. You can see the maximum amount here to purchase your first home, up to 20% of your down payment. Another very popular one that is almost always around. This Dream for All is just around for the month of April, and we'll talk about that. But the California Housing Finance Agency has the My Home Assistance Program. This one gives you less money, but it's typically easier to access this program, and they'll give you up to 3.5% of the purchase price, which is usually your minimum down payment to buy a house. So this is enough money to go towards a full down payment to buy your first home. As we scroll down, you can see CalHFA has numerous programs, and then we start to go into Golden State Finance Authority, which also has many programs. The Chenoa Fund, which has a few programs, and there's also going to be programs that are specific based on Native Americans, people of color. Some programs are going to be based on what is your income amount with different thresholds. But they're veteran status. Are you a military vet? And a lot of people think about the VA loan. Well, did you know that there's a VA loan specific also just to California? So if someone falls into one of these categories, it might open up different loan options. But many of the loans, including, and here we go, now we got some City of San Francisco, City of San Diego. I do want to draw your attention to this little red bar. It says out of funds. So when loan programs do open up, you want to make sure that you're not, kind of taking your time and diddle-dallying. You want to make sure you're pre-approved and ready to buy a home, because some of these programs will run out of funds quickly. Some of the programs have funds all year. But as you can see, dozens of programs available to folks. Here's some San Diego specific ones for the city. There's also San Diego specific county ones that we'll dive into. Two of the biggest ones, though, that a lot of our clients use, and that a large portion of the $500,000 we got last year came from, would likely be the California Finance Housing Agency Dream for All. That's a big one. And the My Home Assistance Program. So with that said, let's dive into the specifics on a few of these programs. And I want to start out with the city of San Diego and the county of San Diego programs. What you're looking at in front of you, and if you'd like to, you can take a screenshot of this. But this is the San Diego Housing Commission programs. And in the top left, you can see two City of San Diego programs, both in green. And as we scroll to the right, I'm going to explain what each of these terms are. In the middle, kind of in pink, you can see County of San Diego programs. That includes some of the unincorporated areas outside of the city of San Diego. And then we also see even Chula Vista and El Cajon have some programs. So as you see these various programs throughout the county of San Diego, what does everything in each column mean? The program area is simply telling you the communities where that program's applicable. The down payment assistance is showing you how much money can you get through down payment assistance from that government body. And you might notice real quickly here that in the city of San Diego, these two loan programs are very different. One of them gives you 22% down. The other one gives you $20,000 down. Well, that can be a big difference. Why does the city have two different programs? And it comes down to AMI. So what is AMI? That's your area median income. And I mentioned that some of these programs are going to apply to some people and some to others, and some maybe to a small few. Area median income, AMI, is how much money do you or your household make in a given year. So let me draw your eyes to the bottom left of the slide. And you can see the area median income based on the number of people in your household. Let's say you're a single person and you make less than 77,200, then you fall into the 80% or less area median income, and you would qualify for that first program in the top left. Now, let's say you live in San Diego, single person again, and you make 120,000. Then you would fall into the second program, 80% to 150% AMI, area median income. And 120,000 would put you right below the 150% AMI, which you see in the bottom left here. 150% AMI is $122,650 for a single person. Now, these numbers go up based on how many people you have in your household, 2, 3, 4, 5, and you can just look at your income, perhaps you and your spouse's income. Do you have children in the household? How many people are in your household? Scroll to the right, see if you fall into the 80% or below AMI, 120% and below, or 150% and below. And that'll help you determine which program on the left you qualify for. We can also see further caveats to each program that you get closing costs covered on many of these programs, or at least a portion thereof. There are sales price limits, but for most of these programs, the limit on the sales price is going to put you in striking distance of almost all first homes. And that could be a first home that's a condo or a townhome, maybe even a single family home. The minimum required buyer down payment. So with these programs, some of them want you to have a little skin in the game. Some of them don't. For these San Diego ones, they do. And there's a minimum that they want you to put down, and then they put down the rest. Like this first one, City of San Diego, 22% down. You put down 3%, so the total is 25% down. The other one with just 1.5% down from you, and the city will put down up to $20,000. DTI, that's simply your debt to income ratio. So what is that? That's a ratio of your monthly debt divided by your monthly income. And usually lenders are going to want to see that at 50% or below. And you can see that for some of these programs, they want it no higher than 45% or lower. And again, that's just the ratio of your monthly debts divided by your monthly income. And they want to make sure that you're not going to have too much of a monthly debt relative to your income. Your FICO score is just your credit score, and you can see 640 is kind of the standard there. You want to be 640 or above. If you're below 640, don't worry. Give me a call, shoot me an email. There's ways we can get your credit score higher in just a couple of months. Your asset limits, They want to make sure that it's not millionaires buying these. So you can see that there's a limit to how many assets you can have, how much money you can have in the bank. Some specific loan terms for each one and closing cost terms. Some programs are going to be grants and some are going to be interest-free loans. So what's the difference between a grant and an interest-free loan? A grant is money the government gives you, you buy your house, you never have to pay it back. An interest-free loan is money the government gives you. You don't have to pay any interest on it. You don't have to make monthly payments on it. But typically, if and when you sell your house, you pay that money back to the government. That's an interest-free loan. So they're just kind of being your nice Uncle Sam, giving you $100,000, go buy your house. And if you ever sell your house, give us that $100,000 back. That's an interest-free loan. So with that, those are the San Diego specific programs. Any questions on those, type them in the chat. And I want to transition over to the big one this month, California Dream for All. As it says on the slide, $250 million. This is big money. The state of California, through CalHFA, is giving out $250 million to California first-time home buyers. Now, there are some caveats to this one, but this one is big money. You can get up to $100,000 given to you. So let's say you buy an $800,000 first-time home. They're writing you a check for $100,000. So California will give you up to 20% of your home purchase price. A total of $250 million, as I mentioned, is being given away. And the program to get a voucher to go buy a home with Dream for All money is going to work like a lottery. And you can enter the lottery during the month of April up until 5 p.m. April 29th. After April, shortly after in May, CalHFA is going to draw names out of this lottery. If your name is drawn, they will give you up to $100,000 to use towards down payment to go buy your first home. And you have 90 days to go find that home. And that's not a big deal. Usually when we work with buyers, we find a home within a month or two. So 90 days is certainly feasible. Now, here's some program highlights. As I mentioned, the program is open just for the month of April. You don't need to buy a house in April. You just need to apply for the program during the month of April. And you have up until 5 p.m. on April 29th. If you wait until 5:01, you missed out. So how do you apply for this program? You need to register for a voucher by first getting pre-approved for a loan by a lender that specializes in the Dream for All program. If you want to get connected to one of those lenders, reach out to me and I'll get you connected. Once you're approved for the loan, you register for a voucher, and that essentially puts your name in the lottery. And then in early May, CalHFA is going to draw those names, and if yours is drawn, you get 20% to go towards that down payment. There are some unique eligibility criteria. Number one, you must be a first-generation home buyer, or if you're buying with a couple, a married couple maybe, one of you has to be a first-generation home buyer. You all must be first-time home buyers. So if you're married, both of you can't already own a home. If you're single, easy. You don't own a home. And you must meet the income limits for your county. So what's the income limit for San Diego? $185,000. You must make less than this. Now, many people in San Diego make less than $185,000. So many people are going to qualify for this, but a lot of people don't know about the program. And a lot of people don't know how to apply. So I'm trying to get as much word out there as possible so that you and everyone you know can try to get in on this program before the lottery closes at the end of the day on April 29th. If you make less than $185,000 and you don't own a house and your parents don't own a house, you probably qualify for this program. and you absolutely should apply. It's one of the best programs out there. Now, this program doesn't work like a grant. It works like a shared appreciation program. So how does that work? You can see in the depiction in front of you a very good example of how this program works with shared appreciation. Now, let's say you buy a home over here on the far left for $500,000. And that's kind of the starting point for a lot of first-time home buyers in San Diego. You can buy a $500,000 home in San Diego County, out in East County, some municipalities, or you can buy a $500,000 condo as your first home, even along some of the beach areas. Now, when you buy that home for $500,000, California is going to give you 20% towards your down payment. So California gives you $100,000 and you borrow $400,000. This is good in multiple ways. It's good not just because you don't have to put down $100,000, California does. It's also good because your mortgage, monthly mortgage payment is now going to be substantially less. Why is that? It's because your mortgage is going to be 80% of the purchase price instead of, let's say, if you bought it on your own and you only have 5% to put down, your mortgage would be 95% of the purchase price. As we saw in that example I did with the Excel spreadsheet. So your mortgage is going to be a lot less month over month over month because California is giving you 20% down. Additionally, you don't have private mortgage insurance. Because California is putting down 20%, it eliminates the need for private mortgage insurance, which is an additional payment first-time homeowners must make when they put down less than 20%. Now, you own the home for 5 years. California helped you buy it. And let's fast forward 5 years. The home has appreciated. As we see in the example, let's say the home has appreciated by $140,000 and it's now worth $640,000. We see that right here in this first box. I mentioned that this is called a shared appreciation type of program. So how does that work? California put down 20%. So they're going to say 20% of the appreciation when you sell, not before, but when you sell or when you refinance, goes to California. 80% of the appreciation goes to you. So in this example where your home appreciated $140,000, but 20% of that is $28,000. 80% of that is $112,000. So you get $112,000. California gets 28. Now at this point, some people say, well, I don't like this program because I don't want to give any of that to California. Trust me, as a guy with a master's degree in real estate and an MBA and a focus in finance, this is as good as life gets. This is a heck of a good deal. Because you've got a, let's call it a silent partner. Your partner, California, is giving you 100% of the down payment. And they're letting you keep 80% of the appreciation. Most people in life, most partners you'll have in life, if they give you 100% of the down payment, they're going to want 100% of the appreciation. But California is being very kind with this loan. And they're saying, we'll give you 100% of the down payment. And you keep 80% of all the upside. And they just take 20% of the appreciation. It's a heck of a good deal for you as the home buyer. Now, let's say you decide to sell this home at year 5. California, remember that $100,000 wasn't a loan, or excuse me, it wasn't a grant, it was a 0% interest-free loan. So when you sell this home, in this example, 5 years later, you pay back that initial $100,000 that they put towards their down payment. When your home sells, they get that $100,000 back. Okay, so you're not losing $100,000. Let me be clear. That's $100,000 equity that was sitting in your house the whole time because they put it in there, and then they just take that $100,000 back. So you're not really giving them $100,000. They're just taking back their $100,000 that was used to buy it, and 20% of the appreciation, which would be $28,000. So what goes back to California is this 128,000, which you see in the light blue. What goes to you as a homeowner? Again, you invested $0, you put 0% down, and if your home went up to 640,000 in value, and you get to keep 80% of the 80% of that appreciation, you keep 112,000. Plus, you're going to pay down your mortgage balance some, $30,000 paid down in this example. You get to keep $142,000. And this is how you build equity. And then you can take that 142,000 and go buy a bigger and better house. And this is how I always tell my clients, the way to buy your dream home is to first buy your starter home, because it's that starter home that really builds the equity for you that you can use later in life to go buy your dream home. So just to recap on California Dream for All, eligibility requirements. At least one applicant must be a California resident. At least one applicant must be a first-generation home buyer. So if you apply solo, it's you. If it's you and your spouse, one of you. So what is the definition of a first-generation home buyer? It's defined as a home buyer who has never been on title, held ownership interest, or been named on a mortgage to a home in the US in the last 7 years. Did you own a home 8 years ago? Congratulations. That's okay. You're a first-generation home buyer. Just can't be in the last 7 years. Also, to the best of your knowledge, your parents do not presently own a home in the US, or if they're deceased, they didn't own a home at the time of their death. So if you have parents that used to own a home, but they don't own a home anymore, you're a first-generation home buyer. The caveat here is really, you don't own a home, your mom and dad don't own a home. There is one exception. If you're a child who's been placed in foster care, or if at any time in your life you've been placed in foster care, then you're also considered first-generation home buyer. Maybe you don't know who your parents were. As I mentioned, max loan amount here, it's going to be $100,000 to $150,000, up to 20% down payment. Again, you have to complete the application to get a voucher, or at least to be put in the lottery for the voucher. So reach out to me if you would like the link that I just shared with you all. You see my email up here is patrick.campbell@compass.com. Reach out to me and I can connect you with a lender that is, lenders have to be qualified to be able to work with the Dream for All program. So not everyone's going to be able to. I'll connect you with a lender who's qualified to work within it, and I'll get you connected to apply for the lottery. And then the steps are, once you get connected to that lender, a pre-approval letter will be issued to you. You'll then begin that pre-registration on the CalHFA site to upload your pre-approval letter. Once it's in the CalHFA portal, you're good to go. After the 29th, they'll randomly hold the lottery, randomly select qualified individuals. And if your name gets selected, you now have 90 days to work with your real estate agent to go out there and open escrow on a house that you want to buy and lock in that voucher. So at this time, the CalHFA program is expecting about 20,000 applications. And they think about 9 to 10% of these people they'll be able to service. So don't hang your hat 100% on this, but you definitely should try, because $100,000 is a lot of money to get for free towards your down payment. But if you don't get this program, because maybe you don't qualify, or maybe you don't get drawn in the lottery, or maybe your parents own a house, don't worry. We have dozens of other down payment programs that we can help you with. Also, this can't be used on multifamily properties, only on single family homes. I mentioned we have a lot of other programs we can help you with, and this is one of them, the CalHFA My Home Assistance Program. We've done this one with many of our clients. And with the My Home Assistance, we get our clients up to 3.5% of the purchase price to use towards their down payment. Now with this program, you must also be a first-time home buyer, but the restrictions are a little bit looser. Your mom and dad can own a house. You just can't have owned a house in the last 3 years. Otherwise, you'll probably qualify for this as long as you meet those income limits, which again is based on how much do you make relative to the area median income. In this program, also, you can't use it on multifamily, has to be single family, but we have helped numerous clients utilize the My Home Assistance to buy starter homes, from single family homes to condos to townhomes. So if I was you and you're thinking about buying a home this year, I would apply for the California Dream for All, see if you can get that money, $100,000 plus. And if you don't get drawn in the lottery, or if you don't qualify because the criteria, then I would apply for one of these other homes, which are really over the counter. There's no lottery involved on most of these other down payment assistance programs. And as you can see an example here, let's say you buy a $600,000 home with a My Home Assistance, you get 3.5% given to you. That's $21,000 in free money being given to you to buy your first home. Then in San Diego, we're a big military town, of course. You can't talk about free money and home loans without talking about the VA home loan, which allows veterans and veteran families to buy homes in San Diego and throughout the nation with 0% down. It's available to military veteran buyers with 0% down, as I mentioned. It also has lower credit requirements. Interest rates on the VA home loan are often lower. It's good for military and veterans. So if you're active duty, if you're retired, if you're reservist, even if you just served for a few years and then you got out, you're probably going to be eligible for this. And there's no private mortgage insurance. We mentioned PMI a little bit earlier in tonight's presentation. You don't have to have PMI with that VA loan. So maybe you're thinking, all right, well, this sounds great. Give me the money. Let's go get a property and let's use one of these down payment assistance programs. But what does the process look like? What does a home buying process look like, especially to a new first-time home buyer? As I mentioned, first and foremost, work with a trusted team. And this is a bit of a shameless plug, but you really are going to find success or failure based on the real estate agent or the lender that you work with. Not like all professions, dentists and lawyers and CPAs and doctors and teachers. You got good ones and bad ones. Same thing in real estate. So work with a real estate agent and team that knows what they're doing. Gain pre-approval with a lender. You first want to get pre-approved so that you know what your purchasing power is. Are you qualified for 400,000 or 800,000 or maybe even more? You don't know what you can even do until you first get pre-approved. So usually when a client meets with us, the next step is we'll introduce them to a lender that we know and that we trust. Once we find out what the buyer's pre-approved for, we can then narrow it down between condos, townhomes, and single family homes, locations, number of bedrooms, number of bathrooms, square footage. We go out there, start looking at homes, submitting offers, and you move into your new home. Now that seems very oversimplified. And trust me, when we meet with brand new buyers, our first meeting is typically 1 to 2 hours just to talk about this buying process. And I'm covering it in just a few minutes. So it really does go much more in depth. But as you can see in the flow chart in front of you, what the most important thing to know is, what does it start with? And it usually starts with that buyer strategy meeting. So one-on-one meeting with you, me, and someone on my team will usually sit down with you and talk about the process of buying real estate. Along with talking about the process of buying real estate at that initial meeting, we will also discuss, what do you want in a house? What's your dream home? What's your starter home? What are your bare minimums? What do you need for bedrooms and bathrooms? Do you need a yard? And that first meeting is really to educate you about the home buying process and to educate us about what you want. After that meeting, you meet with your lender. Then we start looking at homes, making an offer, opening escrow, and closing. Now, when we do look at homes in the age of technology, we are able to use AI, artificial intelligence, and of course, real intelligence. There's no substitution for that, to go out there and search for the perfect home for you in this huge city called San Diego. We know every neighborhood. We know every block, we know every municipality in San Diego like the back of our hands because we're real estate agents. This is what we do, is know our community, know the buildings, the condos, the neighborhoods, the single family homes. And a lot of times a client will say, Patrick, here's like 5 neighborhoods I'd like to live in. And after listening to the 5 neighborhoods that they like, I'll introduce maybe a 6th or 7th neighborhood that fits into the realm of all the things that client likes. And they end up buying one of those neighborhoods, because it's our job as your professional real estate agent to learn about you. And it's like playing matchmaker to match you with the right house. And we have this technology throughout our brokerage Compass where we can find you both off-market properties, yes, off-market homes that you're not even going to see on Zillow. We have access to hundreds of properties that you won't see on Zillow, you won't see online, you won't see working at other brokerages. You see them just through Compass and within our team. And we are able to, after identifying, then analyze the property. 100% of the agents on my team have college degrees. 100% of the agents on my team own real estate. These are a couple of things you want to make sure your agent has so that they know how to analyze, they know how to research, they know how to dive deep into things, including the property you're about to buy. And you want to make sure your agent also owns real estate. Have they gone through the process themselves? Do they know what it's like to be a homeowner? Can they give you advice? Throughout that analyzation process of the property, we'll do a home inspection in which we hire a professional to inspect it foundation to roof, looking at everything from plumbing to electrical to just the structural integrity of that building. Now we're getting towards the end, but I want to go through a few myths real quick before closing it out in Q&A. Top 3 myths of buying a home. A lot of people think, well, I don't need a realtor. I don't need a lender. Everything's on Zillow, Truly, a Rocket Mortgage, whatever. It's all online. The truth is, Zillow is not going to explain to you the uniqueness of every neighborhood and give you the feel. Zillow's not going to learn who you are. A real estate agent working with you is not just sharing with you information and teaching you about the market, but you are sharing with that real estate agent information about you and teaching the agent about you so that that realtor can match you with the right neighborhood and the right house that you likely wouldn't have found on your own. Trust me when I say this, because I used to be a consumer like you. As I mentioned, I served in the Navy over 20 years. I wasn't a real estate agent my whole life. And before that, I wondered, what do real estate agents do? And now that I am one, I realize we do a heck of a lot to help ensure our clients, especially our buyers, are matched with the right home for them. As I mentioned earlier, many times the property we help our buyers buy is one that the buyer never would have known or even thought of in the first place had they not been working with us. Number 2, some people think it's cheaper to rent than buy. As I showed you in that spreadsheet at the beginning of tonight's presentation, a lot of people mistakenly think it's cheaper to rent than buy because they see rent at $3,000 and they see owning as more, maybe $4,000, but they're not looking at the long game. They're not looking at 10, 20, 30 years down the line. And as you saw in the first 10, 15 minutes of tonight's presentation, owning real estate, while it might look more expensive up front, over the long run is exceptionally cheaper. And the most expensive housing you can have is housing you rent. That's by far. A lot of other folks think, well, there's a better time to buy, a better time to sell, a better time to buy my first home. Guys, the sooner you buy, the better. Almost every homeowner I know, if I ask them if you could do one thing different, what would it be? Most of them will always say, I wish I would have bought my first home sooner. Guys, I bought my first home when I was 27 years old. The best time to buy your first home is in your 20s. You're going to be light years ahead of your peers if you buy sooner. If you wait until your 30s, your 40s, your 50s, a lot of your peers are already going to own a home and be 15 years paid off on that mortgage. So I recommend you buy sooner than later. And if you're already in your 30s, 40s, and 50s and you haven't bought your first home, buy it now. None of us are getting any younger. And it goes with my saying, the best time to buy a home is yesterday. The second best time is today. But don't wait. The longer you own it, the more wealth you build, and the sooner that home will be paid off. Also, the longer you wait, guys, the more you're probably going to pay. As we see in economists' forecasts, going from 2024, 25 to 2026, more and more economists are predicting appreciation within the real estate market. In fact, 90% plus of economists are expecting real estate to keep on appreciating at the rapid pace we see today throughout the coming years. So why is real estate appreciating so much? And more importantly, Why are real estate prices not going down, and why will they not go down? It simply comes to supply and demand. We don't have enough supply. It doesn't matter what the product is, in this case, real estate. When supply goes down, prices go up, especially when it goes down relative to demand. And we can see here, going back to the end of 2023, that the United States of America is at the lowest level of housing inventory we have historically seen before, with less than 1 million homes for sale last year. With these low levels of inventory, they are intersecting with high levels of demand. We can see that first-time homebuyers are usually in their early 30s, and that would be the millennials and the post-millennials, Gen Z. Most millennials, most Gen Z want to buy real estate. They're the two biggest generations that we have had in America in decades. And these two huge generations are intersecting with a lack of supply. So really, if there's two charts that sum it all up, it's this showing you the lack of supply, and then second, this showing you the heightened demand, people that want to buy. That's why prices are going up. San Diego is ranked as one of the safest and best markets to buy real estate in. We're ranked in the top 5 markets to buy real estate for 2025. And here's a quick case study of someone who grew $0 to $800,000 using down payment assistance. This is one of my friends, actually, who in 2014, using a down payment assistance program, bought a duplex for $726,000 in the county of San Diego. He lived in one unit and rented the second unit, and the rent on unit number 2 paid for a good portion of his mortgage. In 2020, he sold that same property for over $1 million, made over $295,000, and he made that money tax-free because the government wasn't taxing the money on this property that he owned, because real estate enjoys very unique and favorable tax treatment. And he took that $295,000 and he used it as a down payment to buy a fourplex for just over $1 million. So now he doubled his units. He owns 4 units. The tenants in the other units are paying his mortgage, and he's built tremendous wealth. By 2022, the property was worth over 1.5 million. And as we can see, over an 8-year period, using $0 of his own money, because he used down payment assistance, he was able to grow $0 into $800,000, all tax-free, while getting tenants to pay his mortgage. And as I started at the beginning, I encourage you, don't be the tenant. Don't be the renter. You're paying someone else's mortgage. Be the homeowner, be the landlord, be the person that owns a property and has someone else paying your mortgage. And with that, we'll close it out. Last thoughts, though. In order to cross the finish line, you must first cross the starting line. I meet a lot of people that want to own a house, a lot of people that want to be homeowners, but they never take that first and most crucial step of getting started and crossing the starting line. You will never cross the finish line of life. And whatever your goal is, you will never achieve it unless you cross the starting line. So in real estate, what does the starting line look like? As I mentioned earlier, it looks like a one-on-one meeting with myself or a member of my team. And who you work with does matter, especially when buying the most expensive asset you're ever going to own in your life, your real estate, your home. So I encourage you, if you're interested in buying home, especially if you're interested in buying your first home, or maybe it's an investment property, reach out to me, reach out to a member of my team. We'll be happy to sit down with you for a one-on-one consultation meeting for an hour or two to talk about who you are, what your goals are, and how we can help you. That's what the starting line looks like, a one-on-one meeting to help get you to the finish line. And I also encourage you to check out all of our YouTube videos. All you have to do is go on YouTube, type in Capital Realty Group, and you're going to see numerous educational videos like the one you're watching right now that's going to share with you information on house hacking 101, down payment assistance programs, San Diego real estate update, and even investing in real estate. Just check out our YouTube site. You'll see a ton of videos. And with that, I will close it out for today's presentation. It looks like there's no Q&A, so good to see. I hope I answered every question before it even got asked. And I thank you all for joining us tonight. You see my email in the top right. The best way to get a hold of me is email at patrick.capel@compass.com, or you can shoot me a text at my phone number there. But I respond to 100% of my emails. My team and I, we look forward to helping you in the future and helping you achieve home ownership. Thank you for joining.